London is one of the greatest wealth-generating engines on the planet. Yet, walk into any pub in Zone 1 on a Friday night, and you're surrounded by people earning £70,000, £80,000, or even six figures, who are effectively living paycheck to paycheck. The London paradox is simple. The more you earn here, the more the city finds ways to take it back. In 2026, the average rent for a one-bedroom flat in the capital has climbed toward £2,400. Combine that with a 15% increase in national insurance class 1A rates for some and the relentless convenience tax of city life, and it's no wonder your savings account looks the same as it did 3 years ago. Today, we aren't talking about buying fewer lattes. We're doing a deep dive into the structural, psychological, and tax-based reasons why London swallows your wealth and how to build a fortress around your finances. This is the mentor session most Londoners never get. The number one reason for financial failure in London is a fundamental misunderstanding of sustainable rent. The traditional rule is that housing should cost 30% of your net income. In London, that has shifted to a dangerous 45 to 50% for most professionals. If you are paying £2,200 in rent on a £55,000 salary, you aren't just living in a nice area, you are mathematically ensuring you cannot build an emergency fund. Pro tip: in 2026, the commuter value gap has shifted. With the Elizabeth Line and improved overground services, moving from Zone 2 to Zone 4 can save you £600 a month in rent while only adding 15 minutes to your commute. That's £600 invested into a low-cost index fund is worth over £100,000 in a decade. Common pitfall: choosing a flat based on the advertised rent without calculating council tax. London boroughs like Richmond or Kingston have significantly different rates than Wandsworth. Always check the ban before you sign. London is designed to be frictionless. Contactless payments make spending invisible. When a £2.90 tube fare, a £4 coffee, and a £15 quick lunch happen automatically, your brain doesn't register the loss. We call this the convenience tax. Because you work hard and finish late, you justify the £25 Uber home or the £20 Deliveroo. Over a month, these micro-leaks often total £500 to £800. Pro tip: audit your Monzo categories monthly. If dining and drinks exceeds your groceries by more than 3x, you are paying a massive premium for the city's convenience. Switch to the 1-hour rule. If a journey is under an hour by public transport, the Uber is a luxury, not a necessity. Most people fail to save because they keep their savings in a standard high street account, earning 2% while inflation sits at 3%. You are losing purchasing power every day. Worse, many don't realize that for the 2026/27 tax year, the government has introduced stricter caps on cash ISAs for those under 65, potentially limiting new contributions to £12,000 starting in 2027. If you aren't maximizing your current £20,000 allowance now, you are leaving tax-free growth on the table. Pro tip: if you're a first-time buyer under 40, you must use a lifetime ISA, LISA. The government gives you a 25% bonus on up to £4,000 a year. That's £1,000 of free money annually. Not using this in London is essentially refusing a pay rise from HMRC. Common pitfall: forgetting the 60% tax trap. If you earn between £100,000 and £125,140, your personal allowance is tapered. You effectively pay 60% tax on that portion. The solution? Salary sacrifice into your pension to bring your taxable income below £100K. London is the world capital of performative wealth. You are constantly surrounded by people who look like they are winning. This creates a psychological pressure to keep up. Peer pressure in London isn't about clothes, it's about experiences. The £150 tasting menus, the weekend trips to Ibiza, the memberships at Soho House. Many Londoners spend money they haven't earned to impress people they don't even like. Pro tip: define your big three. Choose 3 luxury areas you truly care about. Perhaps travel, fitness, and dining, and aggressively cut costs in every other category. You cannot have the London lifestyle in every category and still have a London legacy wealth. Finally, people fail because they treat savings as what's left at the end of the month. In London, there is never anything left at the end of the month. Because the cost of living is so high, an unexpected expense, a broken laptop, a dental emergency, or a sudden rent hike becomes a high-interest credit card debt. This starts a debt spiral that is incredibly hard to break in a high-cost city. Pro tip: follow the 50-30-20 rule, but adjusted for London. 50% essentials, 30% lifestyle, 20% savings. And crucially, automate the 20% the day you get paid. If the money isn't in your main account, you won't spend it on a spontaneous night out in Shoreditch. London doesn't have to be a wealth trap. It can be your greatest financial springboard, provided you stop playing the city's game and start playing your own. Cut the convenience tax, master your ISA, and remember that your net worth is more important than your London look. If you found this breakdown valuable, join our community. We're deep diving into UK-specific wealth strategies every week. Hit that subscribe button for HustleWise UK and turn on notifications so you don't miss our next guide on navigating the UK property market.